Decoding the dollar smile. An introduction. The US dollar holds a unique position in the global economy. Its value impacts trade, investment, and financial stability worldwide. Understanding its movements is vital for many. The dollar smile theory offers a framework for this understanding. It suggests the dollar behaves in a specific, non-linear pattern. This pattern resembles a smile. The theory explains why the dollar can strengthen in two very different scenarios. It can rise when the US economy is exceptionally strong. It can also rise when the global economy faces significant turmoil. This dual nature is a key insight. The name dollar smile theory comes from the visual representation of its behavior. If you plot the dollar's value against different global economic conditions, a smile shape emerges. On one end, the dollar is high and strong. This occurs when the US economy outperforms other major economies. Capital flows into the United States, boosting the dollar. On the other end, the dollar is also high. This happens during periods of global risk aversion or crisis. Investors seek safety, and the dollar is a prime safe haven asset. In the middle, the dollar may be lower. This is when global growth is stable and synchronized, and other markets offer attractive returns. This theory was developed to provide a more nuanced view of currency dynamics. It moves beyond simple correlations. The US dollar appreciates significantly when the US economy demonstrates exceptional vigor. Investors become increasingly optimistic about US economic prospects. This drives substantial capital inflows into the country. These inflows increase the demand for US dollars, pushing up its value. This phase reflects confidence in American economic dynamism. The middle part of the dollar smile theory represents a period where the US dollar may weaken. This forms the bottom or trough of the smile. This phase typically occurs when the global economy is experiencing stable and synchronized growth. During such times, investor confidence is generally high across the world. Other economies, particularly emerging markets, might be growing faster than the United States. The US economy itself might be performing adequately, but it is no longer the standout performer it was in the first phase. This relative shift in growth dynamics influences capital flows. In this environment of global prosperity, investors often exhibit a greater appetite for risk. They actively seek higher returns in markets outside the United States. Capital tends to flow out of the dollar and into currencies of countries with more dynamic economies or higher interest rates. Emerging market equities, bonds, and currencies can become particularly attractive. The narrative shifts from US exceptionalism to one of broad-based global opportunity. The dollar, while still important, may see its value gently decline as investment horizons widen. This is not necessarily a sign of US economic failure, but rather of global economic success. During this phase, the US might be experiencing moderate growth. Its interest rates might not be as appealing compared to rates available elsewhere. Perhaps the US is dealing with specific domestic challenges like a growing current account deficit, which can also weigh on the currency. Investors feel comfortable diversifying their portfolios away from dollar-denominated assets. They are less concerned about safety and more focused on maximizing returns. The third phase of the dollar smile theory explains why the US dollar often strengthens during times of global crisis or heightened uncertainty. This forms the right side of the smile curve, mirroring the strength seen in the first phase, but for very different reasons. When international financial markets are in turmoil, or when significant geopolitical risks emerge, investors typically prioritize capital preservation. They seek to move their assets into what they perceive as the safest investments and currencies. The US dollar, along with US Treasury securities, has historically been a primary beneficiary of this flight to safety phenomenon. This flight to safety occurs because the US financial markets are the largest, most liquid, and generally perceived as the most secure in the world. Even if a crisis does not originate in the United States, the dollar often appreciates. Investors fearing losses in riskier assets or less stable economies sell foreign currencies and assets. They then convert the proceeds into US dollars to buy US government bonds or simply hold cash in dollars. This surge in demand for the dollar pushes its value up, often sharply and rapidly. The depth and transparency of US markets provide reassurance during chaotic times. Characteristics of this phase include a sharp increase in global risk aversion. Volatility in financial markets spikes. Section 5. Genesis of the grin origins and core concepts of the theory. The dollar smile theory is primarily attributed to me, Stephen Jen, during my tenure at Morgan Stanley in the early 2000s, around 2001. It emerged from an attempt to better explain the observed behavior of the US dollar, which often defied simpler linear economic models. Traditional models frequently linked currency strength solely to domestic economic fundamentals like interest rate differentials or growth rates. However, the dollar sometimes strengthened when US fundamentals were not obviously superior, or even when global conditions were deteriorating. The smile concept was developed to capture this more complex, nuanced reality of currency movements. The core idea of the theory is that the US dollar's value is driven by two distinct sets of global economic conditions, not just one. It posits that the dollar can appreciate either when the US economy is exceptionally strong and attracting capital, the left side of the smile, or when there is significant global risk aversion leading to a flight to safety into US assets, the right side of the smile. In between these two extremes, during periods of stable global growth where other economies might be performing well, the dollar may weaken as capital seeks higher returns elsewhere, the trough of the smile. This nonlinear relationship is the essence of the theory. Several underlying assumptions support the dollar smile theory. Section 6. Echoes of the past, historical episodes validating the smile. The late 1990s provide a clear example of the left side of the dollar smile. During this period, the US experienced a significant economic boom, largely driven by the dot-com and technology revolution. Consequently, the US dollar appreciated significantly against many other major currencies. The 2008 global financial crisis offered a stark demonstration of the right side of the smile. Investors liquidated assets and sought refuge in US Treasury bonds and the dollar itself. The COVID-19 pandemic in early 2020 provided another complex example. Massive US fiscal and monetary stimulus later led to periods of dollar weakness. Section 7. The dollar's demeanor in 2025. The dollar smile theory remains relevant in mid-2025. The world economy grapples with pandemic aftermath, inflation, and evolving central bank policies. Geopolitical tensions contribute to uncertainty. These factors create a complex environment for the dollar smile. The US Federal Reserve's interest rate stance drives currency markets. The theory's validity in 2025 is strong. Section 8. Winds of change, dedollarization, digital currencies, and other headwinds. While the dollar smile theory has proven robust, several emerging trends pose potential long-term challenges to the US dollar's unique global position. One of the most discussed is dedollarization. This refers to a gradual movement by some countries to reduce their reliance on the US dollar in international trade, foreign exchange reserves, and financial transactions. This is not a new phenomenon, but it has gained momentum in recent years. Nations are exploring ways to use their own currencies or alternative currencies for bilateral trade, or to develop alternative payment systems that bypass traditional dollar-based channels. The motivations behind de-dollarization efforts are varied. For some countries, it is a strategic move to assert greater monetary sovereignty and reduce vulnerability to US economic policy or sanctions. The weaponization of the dollar, where access to the dollar system is restricted for geopolitical reasons, has undoubtedly accelerated these efforts among certain nations. Groups like the BRICS, Brazil, Russia, India, China, South Africa, and its newer members are actively discussing mechanisms to increase the use of their national currencies in mutual trade and to explore the creation of a new reserve currency. These initiatives, while still in early stages, signal a desire for a more multipolar currency system. The rise of digital currencies presents another set of complex challenges and opportunities for the global monetary order. Central Bank Digital Currencies, or CBDCs, are being explored or developed by many countries, including China with its digital yuan, ECNY. These CBDCs could potentially streamline cross-border payments and reduce reliance on existing correspondent banking networks, many of which are dollar-centric. Section 9. The future of the smile enduring framework or evolving paradigm. The dollar smile theory offers a compelling framework for understanding the US dollar's behavior. It recognizes that the dollar's value is influenced by the US economy and global risk appetite. The three phases capture the non-linear dynamics in currency markets. From the tech boom to the financial crisis and COVID-19, the theory has provided insights. Looking ahead, de-dollarization and digital currencies could influence the dollar's role.